As Tom alluded to with spreads, it's a flatter curve. Do you expect that to persist as the Fed makes progress toward potentially bouncing a November taper?
You know, I'm not so sure that the flatter curve is kind of an initial response. But, you know, you look at this meeting and, you know, it's what the market has been waiting for. You know, everybody can exhale. We've been waiting for the meeting where they finally talk about tapering. This is it. And you look at that market reaction, and yes, the curve is flatter, but you got to squint to see that market reaction. This is a very good outcome for the Fed in terms of signaling their intent to give the market information well ahead of the tapering decision. The tapering decision looks like it's going to be announced at the next meeting, and the pace looks like it's $10 billion on treasuries and $5 billion a month on mortgages, and you're done by the middle of next year. And he kind of laid out that plan. It's pretty close to what the market expected, and so you got, you know, not very much reaction, and certainly, you know, lots of other things going on in the world, but, you know, not a down day on equities, no big surprises. So I think the Fed has got to be pleased that their communications on the long-awaited tapering has avoided the dreaded fear of the tantrum.
Yeah, absolutely. And I mean, obviously, the market moves that we're seeing in the bond market, definitely subtle, but certainly something to take note of. I am curious, Jeff, here about some of the chairman's comments, particularly about the employment side of the equation here, and the idea that he's looking at the next couple of employment reports and not necessarily not looking for a knockout, but it's basically just something that would maybe be, in quote his words, reasonably good. What is reasonably good going to look like?
Yeah, you know, it's a continuation of the positive trends of labor market healing and no, you know, significant negative surprises. You know, last month was really had the Delta variant over it. I think they're looking for a resumption to the trends that we saw before that. You know, and it's important that the tapering and even the forecasts of tightening that we saw today, you know, they're all conditional on the progress of the economy and no surprises. So that includes the progress that's implicit in those forecasts on the labor markets continuing to move towards maximum employment. Most people have that forecast, and that's why you saw the dot plot. Most people, I should say, have that forecast realized, and that's why you saw the dot plot do what it did today, pricing in liftoff in 22, and then 3 hikes in 23 and 3 hikes in 24. So you need to get that in the data, and that's what they're expecting.
Do you buy the dot plot, Jeff? Do you care about it? Because it seems like a lot of people don't.
Well, you know, the further out you go, I think Mike McKee mentioned this and others, including Powell himself in the press conference, no, it gets discounted because it doesn't get realized. It is a statement, however, of what the committee is thinking today about near-term policy. And if there's any kind of important impact about today, tapering, tightening, it's that, you know, we're in a very kind of unique period where the Fed is talking about moving towards being less accommodative. And when you have that in the environment where you have shocks like what we saw yesterday and like what we've been dealing with for some time here around Chinese growth and Evergrande and the credit concerns, you know, it sets the market a little bit more on edge when you can't expect the Fed to respond to those market shocks because the Fed's telling you, oh, no, we're talking about and we're focused on the real economy. And what Powell talked about in his answer to the question about, well, financial condition tightening, Fed can't really pivot towards addressing that financial condition tightening as fast as market participants would want them to do. So it sets you up in an environment for a little bit more sensitivity and vulnerability towards those financial market shocks.
Jeff, it's Mike McKee. Before we let you go, I want to get your thoughts on a couple of the tangential issues that came up today. One is the doubling of the counterparty limits on reverse repos. It seems like the Fed is acknowledging that there is way too little paper out there in the markets, and there may be less going forward. And then also the idea that whether or not the markets are taking the debt default idea seriously. He obviously dodged the question on that. But at some point, do we see a reaction?
On the second question, absolutely. There is a point at which you could see a reaction if the markets are surprised. Markets are pricing, this not to go to the final hour and certainly not to have any kind of technical default situation, and that reasonable minds would prevail. We've seen this movie before play out, and at the last minute, if that doesn't show up, certainly markets will take note and start pricing that potential in. On the first part of the question, yeah, this is just more evidence of the size of the liquidity in the market overwhelming, the Fed's ability to control and trying to stay on top of that and recognizing that the size of the program needs to be increased given the size of the liquidity.
What's the market reaction going to be, Jeff, when we get to the end of this taper, whenever the timetable is, whether it's 6 months out, 10 months out here? Do you get a market that then starts to react to the potential for rate hikes, or is that now going to sort of be baked into whatever the tapering process is?
The last time we saw the taper, after they made the announcement it was going to be $10 billion a month and $5 billion a month or whatever the last period was, I'm forgetting, but that's what the new period was. It stops being news, right? We have what I call dino vision from that scene in Jurassic Park. We can only see what's moving, and we focus on the change. Once the Fed announces they're tapering $10 billion, $5 billion a month, it's not really going to be news. We'll focus entirely on liftoff and the timing of liftoff, and that will be the discussion. And as the earlier question said, those out years aren't really going to matter. It'll be all about that pace of tightening. Does it accelerate? Does it get pushed back into 23 because of whatever shock and news and development on the economy we're dealing with then?
Jeff, I'm wondering what this means for the trajectory of Treasury yields, because after the Fed decision and then after Powell's statement, we basically made a round trip and we're right back at 131, where we've been now for about a month. Is the Fed going to be the catalyst for that breakout, or do we continue to hold in this range?
Well, I think if you get to really pricing and the believability that you're pricing in a full tightening cycle, and you've got the growth story that's supportive of that, and you're avoiding outside shocks. It's important to remember the last 4, 5, 6 weeks have been nothing but kind of negative shocks to the outlook. And in that environment, that really holds those longer term interest rates in, and that's partly why we've seen that. If you get into a different kind of environment where the shocks are more balanced, or even that the shocks are turning out to be towards the positive side, you can break out of that range. And certainly the Fed's going to need that kind of more balanced outlook with regards to economic outcomes, both positive and negative, more balanced in those, to be able to make good on those forecasts. And as the market recognizes that and the environment supports that, then I think you can break out of that range into a higher range. Near term, I don't think that's the story, but when you look into 2022, definitely could be on the horizon.
So then what do you do with positioning near term with a potential taper announcement coming in November and looking towards 2022?
I don't think there's a huge amount of surprise in the taper discussion in November. I don't think it's particularly market moving. I think it's hard in the short run to really break out of that range. So I don't think there's a huge positioning change that is required, out of this news. And I think, the other news that we have to keep in mind here, is a potential, for surprises. And the surprises go on both sides. Most of the surprises, as I was just mentioning, have been on the deflationary side, on the negative side. That's kind of helped to hold in Treasury rates. But you were talking earlier about the labor and the wage inflation numbers. If we start to see surprises on the other side, then, that can be another catalyst for breaking out and perhaps a trigger for re-entering, a little bit of shorter duration positioning, a little bit more curve steepening kind of positions if we were to see those kind of inflation numbers that really challenge the transitory story and really support a more persistent story of inflation. I don't think that's happening out of today's news, but that's what we'll be looking for.